All right. I'm always never sure how to title these, but the purpose of this presentation is concerning how money is transferred. And for me, this kind of goes back to, again, kind of the ABCs, one, two, threes of finance and understanding really how it works. I talk to so many people that really don't understand this simple, very simple concepts. And it's something that they never thought about, which is how exactly is wealth transferred. And the reason why that's important is because when you're talking about a budget, you're talking about accounting, right? And unless you have had some education and experience in accounting, you don't know how to account for things. If you were to ask someone without an education in accounting, how do you account for things? I think most people have an understanding of, okay, well, rent, lights, food, gas, insurance, right? Um, but it's really way more basic than that. And understanding the very basic principles and fundamentals are very important to understanding how to construct a budget properly and how to and again how to then account for the items in your budget. Okay, so here we go. There's only four ways to transfer wealth. Only four, and I've been preaching this for uh, better part of 10 years, and I always say if you can come up with another way, please let me know so that I can include it in my four. So number one, you have compensation. All right, what is compensation? Compensation is money in exchange for things or money in exchange for service. All right, and this can be anything from tangible to intangible. We talk about money not buying love, um, but again, that is a form of compensation. If it is possible, in fact, to pay for love, then that is compensation, right? How does this play a part in our daily lives? Is that when you give something to someone, no matter what it is, again, whether it's a tangible or an intangible, right? If there is an expectation of receiving something back in exchange for this thing that you are giving, that is compensation. That is contractually um, a contract of consideration is what it's called, right? The problem is, and I didn't go into this as far as queuing up articles and whatnot for this, but I do want to say this that there are a lot of legalities concerning expectation when it comes to compensation and consideration. And I really wish I did queue up some of this stuff because it is a very interesting subject. And maybe I'll see if I can find something here briefly. But anyway, so for instance, there's one about painting a fence, and the way it works is that if someone comes to your house and they paint your fence and you let them paint your fence, um, and you don't pay them, then you can be sued for compensation. And yeah, I'm not finding this right away, so I'm not even gonna try. Yeah, so if someone comes to your house and they paint your fence without saying anything to you, and you see them paint your fence, and you allow them to paint your fence, um, that person can sue you in court for compensation. And the reason why is because the judge will say, well, any reasonable person will assume that this person was painting your fence not as a gift, but as some sort of service, right? Same thing goes for the window washers is another typical one, right? So when you pull up to the red light, the little kids or whoever, they come to your car and they want to wash your windows. Well, if you see them out there washing windows and you have some idea, right, as a reasonable adult, right, you have some idea that they're out there doing it for money, and you allow them to wash your window, you legally are now obligated to pay them for that service. And we all understand that even if there's not a legal requirement, there is something of a moral obligation to compensate those persons for the work that they have done. So, again, what this means very fundamentally and very basically is that you really have to understand and dial in exactly what it is you're paying for. I meet so many people all the time that are doing things for people, that are paying things for people, and they have an expectation of return, but there was never any sort of contract or agreement or any sort of communication as far as their expectations for what it is that they're paying for. And that, for me, goes back to accounting, because for me as an accountant, and dare I say a natural accountant, I've always had that understanding of, no, we need to get this straight right now. I'm doing this because I expect this back. And it's important that you know that, because if I do this and I don't get what I expect back, I'm going to be pissed off and it's going to ruin the relationship. So let's have this talk now, to talk about exactly why I'm doing this and what I expect back from you, right? And that is, again, compensation that comes in form of both tangible and intangibles, all right? That's number one. Number two, donations, okay? Donation is simply something that you give without the expectation of return. However, you do have an expectation that this donation will be used in such a way that the organization or the person who is receiving this donation will use it for that. And I'll give you an example. If someone is, let's say, holding a sign on the side of the road that says, "I need money for food," right? That is, by legal definition, a donation, because you're giving this person money or help or whatever it is, with the expectation that they're going to use it for food. And we all understand that in those situations where the person does not use it for food, we are upset. Okay, so from a legal standpoint, if you gave a nonprofit organization money, and this nonprofit organization is legally chartered to help fund, let's say, food for the needy, okay? And this organization is taking that money and using it to purchase a jet to fly to Italy. That person has not only violated your trust, but they've also violated laws and regulations that we have in place for these nonprofit organizations, who have said on paper that they are going to use this money for these purposes. And so that's the big difference between donations. So I'll kind of reiterate again. Donation is you give something not with the expectation of something in return, but you give something with the expectation that the person that you're giving it to is going to use it in this particular way. And again, that plays a big part in our personal lives as well, because you need to be really sure that when you're doing something for someone, even if you don't expect anything back from this person, you need to be sure that you are doing it with the expectation that either they're going to use it in a certain way, or you don't care how they use it, right? But you have to have that that communication. You have to have that understanding. Otherwise, you're going to run into problems. Now we know for sure, and I'll kind of go back and talk about the tax implications of this. Going back to compensation, we understand that compensation is tax deductible, and it's money that you don't pay taxes on if you're compensating someone for something that aids in profit making. Okay, if you're compensating someone for your own personal individual benefit, it is not tax deductible. Okay, it is only tax deductible if it is something you're compensating someone for in the expectation of making some profit. For instance, if you if you pay someone to paint your house, that is compensation. But I get this question all the time. The question is that tax deductible? I spent so much money replacing the roof on my house. I spent so much money painting my house, replacing the carpet, replacing the floors. If you did that with the expectation of making a profit, then yes, it is tax deductible. How do we know that you did it for the intention of making profit? Because you actually tried to make a profit. You actually tried to sell your house. You actually tried to rent out your home, right? But if you're painting your house and you're not doing anything at all to try to make a profit, then that was obviously just for you. And if it's just for you, sorry, that's not tax deductible. That's just for you. Um, we can talk about, and I have talked about before, why that is and how that works. But again, at the end of the day, compensation is tax deductible if it's for profit making activities. Donations are tax deductible if they are for non taxable entities. I'm okay with saying that. Donations are tax deductible if they are donated to non-taxable entities. Individuals as they are taxable entities. And we know this because if you as a person make even $1, legally that dollar is taxable as an individual. It is only non-taxable if you are actually some sort of nonprofit, some sort of non-taxable entity, and there are a bunch of them. And I've talked about more than a few in previous videos, and I will discuss more concerning these non-taxable entities, because again, there are a bunch of them. Okay. All right. So that's donations. So let's move on. The third way you can transfer wealth is lending, is a loan. Okay. And I purposely went out and found a graphic for a lending club. This is something that I make sure everyone knows about because this is exactly what I mean when I talk about the steps that we're taking in moving financial literacy and moving financial markets along, right? It's how do we get everyone involved in the financial markets, right? For so very long, it was only banks and those with a lot of money that was able to be involved in these sorts of transactions. That is no longer the case. Now it's still the case for a lot of things, right? But again, we're moving forward. We're getting there. And so Lending Club, along with some others, is one of those steps that we're taking on getting everyone involved in the financial markets. Lending Club allows you to lend money to just random people, whether it be someone that needs help paying rent, whether it be someone that wants to start a business, whether it's someone that wants to put their kid through school, doesn't matter. The point is they can ask for a loan and you can lend the money to them. And then Lending Club is going to act as an intermediary to make sure that those persons are paying you your money plus interest. Okay. So again, the third way that you can transfer money or give money to anyone is by loaning it to them. What is a loan? A loan is anything that you're giving to anyone with the expectation that you will not only receive something back, but something more than what you have given. Let's talk about that. If you do something for someone, and I have had these conversations, so I know it's true. If you do something for someone with the expectation that you're going to get back more than what you put in, that is a loan. It's a loan, period. There's no getting around it. You can't call it anything other than that, you know? Um, but that expectation, that communication needs to happen. And when it doesn't, that's where you have problems. That's where we run into problems. Not only personal problems, not only mental, not only physical, not only spiritual, but financial problems, right? when you're involving yourself in these transactions without even knowing what type of transaction you're going into. And so now you can't effectively communicate the transaction to the person you're in the transaction with. I mean, think about this for a second. If two people are involved in a borrowing lending transaction, but neither one of those persons really understand borrowing or lending, you can imagine how it causes all sorts of issues. Um, I have spoke to persons in the past that engage in loaning and borrowing all the time. And sometimes there's interest involved, sometimes it's not. But this is something that we're very familiar with and very accustomed to. How does this, what are the tax implications of this? Well, um, any sort of loan that you make to anyone, right? If you are not paid back, that is tax deductible. It's called a bad debt expense. Currently, it is limited to $3,000 a year. Um, but that means that if you made a $10,000 loan, you can have a $3,000 deduction every year for 3 years, and then the fourth year you have a $1,000 deduction. I did do a video about this a couple years ago, I think, called Bad Debt Expense. I'll see if I can try to link some of these videos on here. But again, this is one way that money goes from you to another person or you to another entity is by loaning it. All right. Last and fourth is gift. And we're going to talk about this one quite a bit. What is a gift? A gift is any sort of property, cash, anything that's given to anyone without an expectation of anything in exchange. All right. This is where it gets good, okay? Here's the thing. I have met many people who give gifts um, and then later complain that they didn't get anything back. And it is because they were not giving a gift in the first place. But again, from my perspective, I see this as a lack of financial literacy, right? Um, there's a lot of things that we do financially, right, that we're involved in. And the words and terms that we're using to describe these transactions and describe these things are just wrong. And they're wrong just because we don't have the education. I mean, just imagine not having an education in English, right? And we know this to be true for some places and some languages and some cultures where if you have a populace that speak a language, but that populace is not educated, meaning there's no standardized language. There's no standardized grammar. Everyone is just using words kind of however they want. You know what I mean? And so words can take on all types of different meanings. The purpose of education, the purpose of literacy is for standardization, so that when I say this is a gift, I assume that you know what the financial definition, legal definition of a gift is. That's standardization. If you don't know what the legal definition, financial definition of what a gift is, then we aren't communicating on the same level. We can't communicate at this point. Because I'm saying a word that means something completely different than what you think it means because you don't know what that word means, but you use the word. It's a real issue. It's a real issue. But again, that goes back to literacy, financial literacy. So let's talk about this a little bit. A gift is something that you give without an expectation of anything in exchange, and you also lose complete control of that thing. And again, we're talking about tangible, we're talking about intangible. If you give me love as a gift, I can use that love however I want to, and you do not expect anything in exchange for that love. Meaning that if you give love and you don't get anything back, you can't be mad because it was a gift if you gave it as a gift. Again, That's up to you to decide that, right? Because if it's not a gift, then that is on you. That is your responsibility, your duty to communicate that to the person that you're giving it to. If there's some sort of expectation, if there's no expectation, then it's a gift. And you can't tell me how to use my gift because it's my gift. You gave up complete control of it. Okay. So maybe it wasn't a gift. Maybe it was a donation. But again, that's a word that we have to become comfortable with using when talking about personal and interpersonal transactions, because that's what they are. They're transactions. I do for you, you do for me. I give you, you give me. Those are transactions. A lot of people have a problem with that. A problem for some reason with the word transaction. Don't understand. Now, I've had so many conversations with people who have a problem with the word transactional. But a transaction literally is an exchange of ideas, an exchange of energy, an exchange of physical effort, an exchange of physical, tangible products and currencies. Those are transactions. That's what we do as humans, day in and day out. Um, Now, four things. There we go. So you can donate, you can gift, you can compensate, and you can loan. There is no other way to transfer anything. So when you're talking about how you spend money, when you talk about your budget, remember there's only four ways: compensate, donate, gift, and loan. There is nothing else. And if you can come up with something else, please let me know. I would love to hear it so that I can study further. So let's talk a little bit about gifts, because a lot of times what happens is when I have these conversations, the first thing someone says to me is, well, what about support? Clearly that's a different way of transferring wealth. And it's not. It's not. So if you have a child or a friend and you take them out to eat because they're hungry, that is either donation, a loan, compensation, or a gift. That's it. It's one of those four things. Can't be anything else. Unless you can come up with something else. It can't be anything else. You got to really think about this stuff. If I take a friend out to eat, the question is this a gift, or is this a donation? Or is this compensation? Or is this a loan? See my point? If I take you out to eat without any expectation of anything, that means that if you choose to get your food to go, I can't be mad. See my point? But if I expect you to eat with me, that's a donation, right? If I take you out to eat, but I expect you to take me out to eat later at some point, then that's compensation, right? If I take you out to eat, but I expect you to do something else for me later that may be of greater value than this meal that we're having, we all understand what that's about. Business meals, we all know. I'm taking you out to eat so that I can get something greater later. That is a loan. That's how we need to talk about these transactions. That's how we need to talk about these things that we're doing, because that's what they are. All right, so let's talk a little bit about gifts and how this stuff works. So first things first, I queued this up backwards, but inheritances. When someone passes away and you receive something from this person after they have passed, that is an inheritance. While the person is alive, it is a gift. Let's go through that again. If I'm alive, there's four ways I can give something to you, right? Once I pass away, I can't do that anymore. I'm not here to receive anything. So the only way that I can give you anything after I pass away is as a gift. Now we can talk about estates. That's a whole different thing, because estates is an entity, which is a person, which is alive. Right now we're just talking about me being dead, right? The only way I can give you anything as a dead person is to An inheritance means that wow, I don't know the word for that. I aired it to you? No. I left it to you? It's not really what I want to use here. Anyway, an inheritance is a gift. Okay. And what you're seeing here is the IRS definition of such thing. And it talks about exactly how to value an inheritance. Typically, if I gave you, let's say a house, right? When I passed away, that gift that you received is valued at the time that I passed away. So let's say I bought the house for 100,000, but by the time I passed away, the house was worth 200,000. Well, now you own a house worth 200,000. You don't own a house worth 100,000. It's 200,000. Same goes for if the value of the home is worth less than what I purchased it for, then you own that home for the higher value actually, and that's going to change from state to state sometimes. I forget exactly what the rule is concerning that for tax purposes, but just know that there are differences, right? So if the property value is less at the date of passing than it was when the person purchased it, then you may have a basis in the property based on what it was purchased for, not based on what the value was when they passed. All right. So that is inheritance. And of course, I'm putting these links in the description so you can go and read through them yourself. All right, here we go. So here we go. My mother transferred the title of her home to me. Do I need to report this transaction to the IRS? So again, this goes back to inheritance as a gift. If the person is alive, then it is not an inheritance. It is classified as a gift. Okay, and we can talk about taxable gifts. All right, this is a subject that is very interesting to me. I'm going to try not to go too far into it because I don't want to go off the rails here. But there are gifts in which you have to pay tax on. All right. Go down the list here. All right. So now we're getting into, again, taxable gifts, but also this thing called support. Right. So if you are and here's a way to look at it. I was not able to find this, but I know this to be true. Right. One of the ways that you can prove in court whether or not something was a loan, donation, gift, compensation, so forth, is how exactly it was done. Think about it this way. If I give you money and I never communicate with you about giving me that money back, right? Never have a communication about it, never write anything down. It's going to be really hard to prove that that was a loan. Get me? Okay. If I give you a gift and let's say I give you a gift once a year, or 3 times a year, 4 times a year. You can say, okay, that's a gift. But if I give you a gift every week, if I give you a gift every couple days, and I do that for a period of a couple years, at some point, that's no longer a gift, right? And this has come up quite a bit in different court proceedings. At some point, that's not a gift because a gift is something that does not happen consistently. There's one thing about, a gift, like I said, on a birthday, on a holiday, you know what I mean? That's something that's done, 3, 4, 5, 6 times a year. It's done maybe sporadically, right? But when you get into giving a gift every day, every other day, once a week, on the same day, close to the same time type of transaction, at some point that's no longer a gift. And so that's how we kind of get into some of these tax implications, right? Of what is a taxable gift and what is not. So um, basically, starting off, any gift you give to anyone up to about $10,000 or $12,000, 15,000, I think, right now, um, is not taxable. Once you get above that $15,000 mark, any gift that you give someone over the course of a year, you actually have to pay taxes on that. Okay, and the reason for this is and it's so funny to hear people complain about gift tax and estate tax. But the purpose of these regulations are to keep the rich from staying rich. Because if I have $1 billion, I can simply just gift that money to my family and my friends, and then they'll have $1 billion. And that money will never leave our family. It'll stay in our family. And so the idea is to make sure that the rest of society is getting at least a piece of that by the way of estate tax and gift tax. Now, there are some loopholes that I wanted to look at very quickly. And this is one I'm right here. So it says no part of a gift to an individual who has not attained the age of 21 on the date of such transfer shall be considered a gift of a future interest in property for purposes of subsection B if the property and income therefrom may be expended by or for the benefit of the donee before his attaining the age of 21 years and will to the extent not so expended past to the donee on attaining the age of 21 years, and in the event the donee dies before attaining the age of blah, blah, blah. Okay. What this means is that any person under the age of 21, if you give them money and that money is used right now for their benefit, okay, and that money is being spent before the age of 21 years old, that is not a taxable gift. Personally, I disagree with this. Okay. Um, and again, this goes back to the purpose of the regulation. If you have a parent that is giving their 16-year-old $10 million, I don't see how that's fair to the rest of us. All you're doing is keeping the money in the family. Um, and that's not the way this thing is supposed to work. You know? Um, And the purpose of the gift tax is saying, listen, if you're going to transfer money to your family, to your children, you have to pay some tax on that. Okay. Now, I'm saying $10 million. Can $10 million be spent on a 16-year-old before they reach the age of 21? I don't know. Not my concern. But this kind of stuff does happen. You know, I mean, we've all read of stories of parents buying children like super expensive cars, and you think to yourself, like, but that's kind of where we are right now. Personally, I want to see that change. I really like the idea of those gifts becoming taxable because we rather that money leave the family and go to the rest of society than staying inside that family. Let's see if I got something else in here. Yeah. Education. Where is it at? There we go. So, a qualified transfer will not be treated as a transfer of property by gift for purposes of this chapter. Okay. A qualified transfer is tuition to any educational organization for the education or training of such individual to any person who provides medical care with respect to such individual as payment for such medical care. So what we're talking about is we're talking about not only medical benefits, but also for education, right? The money that is given to basically a child in this case, or grandchild, or niece, nephew, whatever, right, is not considered a taxable gift. I'm sorry, no, it is considered a taxable gift for, like I said, tuition and medical care, right? But again, it's a gray area because if I give the money to the kid and the kid uses it for tuition, you know what I mean? But again, this just goes back to support, right? At the end of the day, feeding your child, you have to decide, is that a loan compensation, gift, donation. It can only be one of those four things. Okay. I really like the idea of compensation. Of course, something like this has to be done in the context of a profit making activity. For instance, if you have a child who is in sports, you spend money for that child to learn the game and to do the practice and all these things with the expectation that this child is going to make money at this activity and then pay you as management. You know, we all heard the stories. We all know the American theme, which is, you know, your child does sports, your child comes back, they buy you a house, right? Or the child says, what do you want to do with these millions of dollars that you made in this sport? Oh, I want to buy my parents this and that, right? So from my perspective, that is a profit making activity. And so any money spent on this child um, in route to that outcome is considered compensation within a profit making entity. And again, I always suggest partnerships. I think it's the best way to go. Um, you know, but that goes beyond just sports. I mean, we're talking about instruments. We're talking about really any activity that you can indulge in or indulge your child in. The other thing that I really like is future services rendered. So, you know, we all know it's a cultural thing, right? Where children are expected, again, see, expectation, to take care of their parents in their old age, meaning that I'm feeding you now today so that you can then give me free services later. That's compensation, right? And that can definitely be done in the context of a profit making activity. However, that one is a little harder to prove because, again, this is something that's going to benefit you personally. Um, but again, that is definitely a possibility. And I know for sure we are engaging in those types of transactions where we're saying, listen, I don't mind feeding you, clothing you, you know, looking after you, teaching you, all these things, the tangibles and the intangibles, but it's done with the expectation of a future benefit. Okay. So that is definitely compensation. And again, we have to really start to have the conversation, but first understand the concept and the vocabulary for these transactions before we can have the conversation, right? Um, there was one other thing that I want to take a look at, and again, it's against gifts, and it's defined here as transfers for insufficient consideration. All right, transfers for insufficient consideration. And the reason why that's so important is because we're talking about giving something with the expectation of receiving less back. So remember, we said that a gift is giving something without the expectation of receiving anything, but it can also be defined as giving something with the expectation of receiving less than what we have given. And I think that's really important to think about, right? Um, in what situations do we find ourselves giving something with the expectation that we're going to get less back than what we're giving, right? And so even though there is an expectation to receiving something, the fact that we're receiving less nevertheless means that it's still a gift. Okay. And of course, there are tax implications for that, a lot actually. And it's something that um, I go through with clients all the time. Okay. And it's really important. So if, then we have something called at arm's length transactions. At arm's length transactions means that you're doing business with someone who is related to you, or you're doing business with someone with whom you have an intimate relationship. Those are called arm's length transactions. And the reason why those are so important is because we know human nature is that we're going to give our friends and the people that we're cool with deals. Well, can't do that. If I sell my friend a house for $1 when that house is worth 100,000, I have just gifted them $99,000. There is no getting around that, right? And so again, remember, that makes it a taxable gift, and you, the person giving the gift, have to pay that gift tax. You're responsible for filing that gift tax return and paying that gift tax on that $99,000 gift. Okay, it's really important to understand that. But like I said, I can't reiterate enough how this plays a part in not only our financial lives, but also our personal lives. Um, as pretty much it's wholly disregarded the entire value of the property transferred constitutes the amount of the gift. Yeah, like I said, you can read some of this stuff yourself, but I think I summarized it fairly well. It just talks about again what happens when the thing transferred is way more than what you're getting back. Okay, so again, it's still a gift.